Well, let's take a look at the macro picture and how that's determining I guess those investor moves at the moment, what we should be considering as we head towards the end of the year. Grant Mundell joining us from Equity Trustees. Grant, good to have you back on the show.
Hi, Andrew.
Lots to watch at the moment, macro-wise, and I guess you only have to look at gold's performance at the moment to see that clearly investors are concerned. There are multiple concerns, I guess. Yet, I mean, not only gold, but of course we see so many risk assets moving to records at the moment. What do you see as driving that, and what are the risks at the moment for investors?
Yeah, look, I think there's a couple of key drivers. Obviously, we've seen central banks lower interest rates, so that's been a positive fillip from a liquidity perspective. So it's certainly been helpful for investment markets across the board. Obviously, the AI thematic and the amount of spend coming through from the hyperscalers has been another key, obviously, driver in terms of international equity markets and the strong earnings growth that are driving international markets overall. So I'd say they're probably the two key drivers at the moment. What I'd say conversely around that in terms of risks at the moment is that if we do start to see some emerging signs of inflation, and we are seeing some, especially with things like the tariffs through the US, just filtering through over the course of the next 3 to 6 months, if we do see some inflationary pressures and therefore the market starts to price in less interest rate cuts in the US, that could be a little bit of a headwind for equity markets. Secondly, we'd sort of highlight that in terms of the AI trade and the AI thematic, there's been a lot that have been sort of quite levered to the drives and the pushes in the market on the back of that. So if we do see some perhaps, concerns around the nature of some of the deals that we've seen more recently around this sort of vendor financing or cross investment that we've seen, I think investors are raising their eyebrows a little bit around that. So that's something to watch. I think investors around that AI trade will continue to monitor what sort of return on investment companies are going to be getting for those hundreds of $billions worth of investment coming through. And if we do see any sort of falteration in the AI trade, that's going to flow through to a lot of other sectors. I mean, we look at US GDP growth, that's being really supported by the data center capex that's coming through. Obviously, it has an implication on electrification, has an implication on commodity prices such as copper. So there is a broader impact or second derivative impact on other parts of the market. So I think that's things that, not immediate, but certainly people are going to be more conscious of.
Should we be concerned about that concentrated leadership we're seeing on Wall Street at the moment? And it is all about that AI trade, essentially. Where do you see the market at the moment, given it's certainly priced to perfection, isn't it?
Yeah, certainly that's our concern. Valuations in equity markets, and if you actually look across most asset classes, they're pretty fairly to fully valued. But equity markets in particular, tactically we're slightly underweight equities. We want to have exposure there, but the valuations are the real constraint at the moment. If we look at international equities, earnings growth is very, very strong, obviously driven by that tech sector out of the US. But we would highlight there are pockets of value, and that's what we'd be advocating for investors to look at, is looking to diversify their exposure across different asset classes and different parts of the market. So within international markets, if you look at certain parts of emerging markets, Europe, even the Japanese market, for example, some of the fundamentals are improving there and they're looking at better value. If we look at the Australian share market and you look at underlying sectors, we'd say something like the healthcare sector, for its relative growth, is priced very attractively, and you've got uncertainty probably to a degree lessening out of the US now. So there are certainly pockets of value that you can look at. So you can still have exposure to things like equities, but you just got to look for those pockets of value, I think. But certainly the narrow market leadership has, which really drove last year's gains, have sort of come to the fore again over the last 3 to 6 months.
You mentioned the Australian market. You see opportunity there in healthcare. What's your view on resources, given those underlying commodity prices have really taken off?
Yeah, I think resources are looking more interesting. Commodity prices, obviously gold's one which we've touched on, $3,000-4,000 an ounce overnight. There's a range of factors which are driving that. But outside of that, if you look at other base metals and even perhaps other critical minerals to some degree, we're seeing a little bit of a restriction on supply, and it probably started out of China through that anti-involution type trade. We've seen obviously some supply disruptions in things like copper, with tech again overnight highlighting some concerns. So we're seeing that demand is resilient, but supply seems to be tightening up a little bit, and so we're now starting to see commodity price upgrades, which are leading to earnings upgrades in the resources sector, which we haven't really seen for some period of time. And if you look at something like the banks and why they did so well, part of the reason was that resources were really on the nose. Commodities were under pressure, resource companies were seeing earnings downgrades, dividends were being cut, and therefore money was flowing into the banks. Now we could be starting to see a bit of a reversal on that.
So Grant, you said you're underweight equities at the moment. What is your portfolio makeup?
So at the moment we'd be advocating, stick to your sort of strategic asset allocation or the investment strategy for each of the different clients. But tactically, slightly underweight equities. We'd be slightly overweight, therefore, some of the defensive asset classes. Things like listed Australian credit we like at the moment. Whilst credit spreads are fair value or reasonably tight at the moment, we'd highlight some fundamentals in the market which are quite positive. If you look at the economic backdrop, that's supportive, corporate fundamentals are good. The issuances coming through from even offshore issuers are quite high quality, and you're seeing ratings upgrades for the domestic issuers as well. And if you look at the investment demand, especially out of places like Asia, it's very, very strong. And with the end, the sort of progressive end of AT1s, you'll see more money move into that corporate debt market. So we think that market can continue to be supported.